Hello, my Life with Crypto brothers and sisters. Welcome to another Money Monday live training. For today's topic, I'll discuss tax basics for crypto transactions. So I want to start today's training by reviewing 5 myths about crypto and taxes. And then afterwards, I will go into what is required to actually get started on preparing a tax return, which also means dealing with your crypto trades. So let's start with the myths. The first myth is the biggest myth. I only need to calculate capital gains and losses when I sell crypto back into fiat currency. And this is not true. IRS guidance that came out back in 2014 says that cryptocurrencies are treated as property for tax purposes, and all trades between crypto or between crypto and fiat are considered taxable. And just as a reminder, stable coins are treated just like any other cryptocurrency. The second myth is that if I buy crypto from a friend, I don't have to keep track of the trade or calculate capital gains or losses because the transaction can't be tracked. And this is also not true. When someone sends you crypto from their wallet, it goes into your public wallet. So it's possible for the IRS to track your trades using blockchain analysis technology by firms like Chainalysis. And there's now several different businesses out there that do this kind of blockchain analysis, but Chainalysis was the first, and I do believe they are contracted by the IRS. The next myth is when I use cryptocurrency to pay for things like coffee or cars or houses, it acts like money, so I don't need to track my purchases. And the IRS says that this is not true. In the US and most countries, cryptocurrency is not legal tender. I say most countries because I believe there's at least one out there where it is legal tender. But in the US, it is not legal tender. Therefore, the IRS still considers it property even though it acts like money when used to buy stuff. Technically, every purchase should have capital gains and losses calculated on it. However, some politicians have tried and may be still trying to pass a bill imposing a $600 threshold on purchases with crypto. And if the bill ever passes, capital gains would only have to be calculated on purchases over $600. I truly hope that someday that goes through. The fourth myth is if I own crypto inside a trust or an LLC, there's no tax on crypto transactions, or there would be less tax on crypto transactions. Only IRS tax-exempt entities can altogether avoid owing taxes on crypto profits. Crypto owned inside an LLC must still be reported and profits may be taxable. However, crypto capital losses could offset other capital gains within an LLC. Okay, let's move on to the fifth myth. I don't have to report trades made on a centralized exchange unless the exchange sends me a Form 1099-B, and this is not true. As you may have guessed, whether the exchange provides trade information or not, IRS guidance states it's the taxpayer's responsibility to report it on their tax return. However, new legislation affecting crypto exchanges is coming. The American Infrastructure Investment and Jobs Act of 2021 will require centralized exchanges to report trading activity to users on Form 1099-B starting in 2023. And anyone who's traded stocks and equities know very well what a Form 1099-B is. You receive one every year that outlines all of the trades and the profits that you've made. And crypto exchanges have never been required to do that, but it's coming in 2023. So the next section is how to prepare for a crypto tax return. Many of you know that I was a tax accountant with my own practice for about 15 years, and I retired in 2021. And I wrote 5 ebooks on the subject of crypto and taxes called the Crypto Guard Tax eBooks. And you can go check out my tax ebooks on lifewithcrypto.com. There's 5 books and a crypto tax organizer. So there are 4 steps to preparing crypto trades for a tax return. And I'm going to briefly go over all 4 of those steps here. I highly recommend that you use a tax organizer to get your trades all gathered in one place. And there's more to crypto than just trades these days. There could be rewards, you have deposits, you have withdrawals, you could have made a purchase for some other product, like I know some people buy houses with crypto, but you could also buy a sandwich or a cup of coffee. And you can keep track of all of that starting with an organizer. So you can use my 5-page CryptoGuard tax organizer to gather all of the correct data. You can find the organizer in the same place where all the ebooks are. And this tool will help you save time, money, and frustration. Members of the Let's Crypto Club, which I've just started announcing, will receive this organizer as part of their subscription benefit. And everybody who's ever used my tax organizer loves it. And it really will help you not forget what to go looking for when you get ready to pull all your trades and other transactions together with crypto. The next step is to reconcile crypto trades and apply the best capital gain method that shows the least amount of tax owed. The easiest way to accomplish this task is with portfolio tracking software. And here I've given you a sample, if you can see that on the screen. Here's one line from showing what it looks like in a particular tax software. I've been using cointracking.info for years, and this is what it looks like to see what unrealized and realized gains might look like in a tax software. And as I said, I've used cointracking.info for years. It's sophisticated software that allows for tracking every type of crypto transaction, not just a basic trade. Some of my former tax clients, they like using something that's now called coinledger.io. It was previously called cryptotrader.tax. And I liked that software as well. And there's lots of others out there on the market. Those are the only two that I'm going to mention in this training. Feel free to go check them out, and they're a great place for you to gather all your crypto trades and figure out what capital gains you might owe. Now, once you get all your crypto transactions reconciled within the portfolio software, the next step is to generate a tax report using various capital gain methods to determine which way creates the least amount of tax owed. The most common method is FIFO, which stands for first in, first out, but it may not be the best choice. And that's why I recommend using tax software, because it's very difficult to figure this out in a spreadsheet. So you want to check out these other capital gain methods called LIFO, which is last in, first out, HPFO, highest price, first out, etc. There's several to choose from. And accurately reconciling trades is the most time-consuming part of preparing a tax return that has crypto on it. And keeping good records is imperative. And before I continue, just to make sure everybody knows what I mean when I say reconcile your crypto trades, here's what it means. You have to gather all of your buys and all of your sells, all of the times you've purchased crypto and all of the times you've sold crypto. You gather those into a database, which is a portfolio software. And in that software, you tell it to run a transaction report using a specific capital gain method. Last in, first out means it's going to go find the last trade that you sold and compare it to the first time that you bought. So it's going to compare when you bought and when you're sold to determine what the profit or loss is. And the IRS has actually specifically stated that we are allowed to choose whichever capital gain methods generates the least amount of tax. So the best way to do this is inside some kind of a portfolio tax software. So once you've completed reconciling your trades, the next step and the last step is to generate what's called Form 8949. And this gets generated from the capital gains report that was created inside the portfolio software. The form gets filed with the tax return. You either give it to the tax preparer who's preparing your tax return, or you include it inside your self-prepared tax return. And here's a sample of what an 8949 looks like with some crypto trades on it. So that's all I want to go over today. I've done quite a bit of trainings, and I have written all my ebooks on how to prepare trades for a crypto tax return, the most important thing to remember is you've got to align your trades, your buys and your sells to determine how much profit or loss you had. Of course, if you have a profit, you'll end up owing some tax. If you have a loss, it may offset with other taxes that you have on your tax return. But that's, everybody's individual tax return is very unique to that person. So I can't really give tax advice through a little training like this, but I hope that gives you some information to know where to start. So that's it for today's training. And as with most crypto topics, there's a lot to unpack. I hope you found the training helpful. If you have questions, leave them in the comments and I'll respond as quickly as possible. And if you enjoyed today's training, please leave a 1 in the comments and share your thoughts. If you'd like me to do a training on another particular topic, please let me know in the comments section. This training was requested by one of our members. Rita, I believe was her name. So I hope that, Rita, that you enjoyed this training, and I hope everyone enjoys it as well. So that's all for me today. Thanks so much. Bye for now.